People were worried that with the Trump tariffs coming in, you can see a spike in inflation. But to be fair, I don't think that has got passed through. I mean, till now, a lot of the increased tariffs have got absorbed by other intermediaries or the producers and so on.
So if the labor market is weak, that leads to weaker consumption. And the only thing driving the economy right now is AI.
Every day you hear some of these large companies, the tech guys cutting jobs. So that is starting to impact. And with that in mind, rate cuts have to start happening.
So I'll just set the context before I get into the questions. So the topic is navigating global turmoil, can India stay the course? The global economy appears to be navigating through uncertain times. The recent US tariffs have unsettled global trade dynamics, signaling that globalization as we know it may be undergoing a fundamental transformation. India has been hit by 50% tariffs and is currently negotiating a trade deal. On the domestic front, both fiscal and monetary authorities are working in tandem to counter the slowdown in consumption and support economic growth. The government has announced direct and indirect tax cuts to spur demand, while the RBI has cut repo rates by 100 basis points to inject liquidity and lower borrowing costs. However, the question remains, is this enough, or does this situation call for further coordinated action by both the government and the RBI? Now, my first question will be to three of you. Now, the Fed is meeting this week. The commentary suggests that they'll go for a 25 basis cut, and going by Mr. Powell's commentary in the past, there could be further cuts as well. Where do you see the US interest rates heading, and how does this play out in the Indian market? To Mr. Bagri first.
Thank you, Sugata. Let me first start by saying I think there have been quite a few events over the last 3-4 years which could have qualified for causing global turmoil. But somehow I think the global economy as well as global markets have handled it quite well. I think has been quite resilient. In fact, I think most of the equity markets globally are at or close to its highs, right? So I think we have done a good job. A lot of it is, of course, due to policy support. And a lot of this is, I think new things that have been happening, investments in AI and so on, right? Coming back to your question now on US, I think there are 3 themes which are playing out broadly in US. Right? I think there's an acknowledgement now that there is some sort of slowdown in labor market, right? Especially, the young graduates, 22 to 26-year-olds. I think the unemployment rate there has been quite high recently. So I think that acknowledgement is coming through. I think the second thing is, people were worried that with the Trump tariffs coming in, you can see a spike in inflation. But to be fair, I don't think that has got passed through. I mean, till now, a lot of, the increased tariffs have got absorbed by other, intermediaries or the producers and so on, right? And I think there's also a belief now that any pass-through in inflation is going to happen a lot more gradually than what people were expecting earlier. And I think the third point also I do want to bring out is while we are seeing growth in US markets, I think, a lot of that has been concentrated from, investments related to AI or ancillary sectors like data centers, power, and so on. It's not been as broad-based as people would have expected or hoped for. So, and plus now with the US shutdown, I think that also going to have an impact on the GDP, at least in the short term. So given all of this, we actually think that we expect a rate cut today. And overall, I think we still expecting 4 to 5 rate cuts in US over the next 1 year. And I think the market is also pretty much pricing the same.
So, I think broadly agree with what Aditya said. I think the interesting thing in US is that, in the first half, the GDP growth was 1.5%. Almost 2/3 of it is driven by AI investments. And AI, by AI, you don't just mean chips. I mean, there's so much investment which needs to be made in other things like power, like in cooling plants and stuff like that, and air conditioning. So I think besides that, the growth is weak. And I think the reason for that is that labor market is weak. So if the labor market is weak, that leads to weaker consumption. And the only thing driving the economy right now is AI. So, given that and given the fact that, the labor market is weak, I think Fed is going to cut rates. My sense is that, the other thing which Aditya said, I don't particularly agree. I think which is about the pass-through to inflation. So what's happened is that, so far the US corporates have been absorbing, whatever the cost of, the higher tariffs is. But eventually it has to go to the consumer. And that process has been slow because, a lot of imports happened before the tariffs kicked in. And the cheaper inventory is, still allowing, the producers to sell at a low cost. I think a lot of studies have been done. Typically, I think the analysis suggests that almost 60-70% of the cost is being absorbed by the US corporates and consumers are not paying as much. But this will change. Eventually consumers will have to pay more. So I think Fed is in a bit of a soup, both their mandates. They're supposed to keep unemployment at the full employment at the full employment level and, inflation around 2%. They're failing on both the mandates now, which is worse. So I think in the near term, the call is that, they want to cut because labor market is weakening, but eventually inflation will catch up. And I don't think, so 2 cuts now and in December. After that, I think they will be on a pause. They will want to wait and watch how inflation is evolving. And, the next Fed chair comes in May. And, so probably post that, you might get one more cut, is the way I would look at it. But I don't think the terminal rates are going to be as low, 100 basis lower. We are talking maybe another, 3 cuts from here.
Mr. Akshay.
Hi. So normally it becomes difficult when you are the last speaker and if there is consensus. But good, this time there doesn't seem to be consensus, so it's an easier one to handle. Now, I think I would, people have, Aditya and Shailendra both have spoken already about the challenge on the labor market and also the fact that the AI investment has been driving the investment scenario. I think that at least there's consensus on that. But that is also starting to have job losses. And every day you hear some of these large companies, the tech guys cutting jobs. So that is starting to impact. And with that in mind, rate cuts have to start happening. Today is more or less is a given data point. Whether it's 5, whether it's 3, I would still agree that with Shailendra that somewhere after 2 or 3, there will be a pause, evaluate and then come through. Because yes, the inflationary trend will start kicking in at some point. The price differentials was the US corporates were able to absorb some of the tariffs quite significantly. They were absorbing it, but that was because there was always a hope, or there is still a hope that something will come out. So like if you look at an Indian exporter, very minor was being absorbed by the Indian exporter at this juncture because there was a lot more which could be absorbed by the US guys, and supply chain can't be changed so fast. But if it continues in this manner, then a large part of it will be passed on to the US consumers. So I would tend to agree possibly 2 to 3 cuts and then a pause and then see how it comes through.
What does this do to the capital inflows to emerging markets, especially to India? If I can start with Mr. Akshay. Because we've seen
capital inflows may or may not get impacted just because of rates. See, I think the challenge what India has seen in the last 2 odd years or a little more has been that India was seen as an overvalued market, and a lot of that money was being taken out. And in the last 6-8 months, a lot of that money started going back into China. Initially, it was obviously China was not being looked at, but I think globally that has happened also. And I think the India capital flows back to India in the public markets will also depend on a lot on the results. It will not just be where, there will be some of you are hearing of the banking sector capital flows coming in. So those kind of strategic flows may or may not come, but I'm saying from a overall capital flows coming back into India, it will be more result driven than just an interest rate play out here.
Coming to India, we heard Ms. Poonam Gupta saying there is space for some cut. How many cuts do you foresee RBI doing, and where would you see the rates?
So I think, probably the need for cuts is not going to be there. I mean, I think I'm reasonably bullish on growth going ahead. I think what has happened is that there's been 100 basis, of cuts which have already happened. There has been an infusion of 7.4 trillion of liquidity. Of course, some of it is going out because of the FX intervention RBI is doing, but liquidity conditions generally have been stable. There's been a fiscal stimulus of 3.5 trillion, both direct and indirect taxes. Recent measures by RBI in terms of deregulation, in terms of the ECB flows, in terms of allowing banks access to acquisition financing. I mean, these are all measures which will, start showing up. And I mean, we see signs that, in some sectors, I think Dr. Poonam Gupta spoke about it. I mean, CapEx intentions are, there, and they are picking up. So I think the growth will improve, though I don't agree with, I think so far growth has been weak and the GDP data hides it. So the way to look at, I mean, there is a way that the GDP deflator gets calculated. I think that sometimes overstates, sometimes understates the real growth. I think the only number to track is the nominal GDP, and that has been slowing. So I think so far, whatever RBI did, I mean, it will help, arrest that. And, going forward, probably there is not much need for rate cuts, but just because RBI has given a guidance that, there is scope to cut rates, I think they'll go ahead and cut in December. After that, there's a long pause. I think after that, maybe even the liquidity, which they have been maintaining in surplus, they will probably want to, bring the surplus down and keep it more at a neutral level, around 1% of NDTL or below that. So I think, December is a touch and go. I mean, and I think a lot will depend on the trade deal. Let's say the trade deal by then is not announced, maybe just as an insurance, RBI might want to cut. But I think if the trade deal with US goes through, maybe they will, not cut also.
Mr. Bhargava.
So I kind of agree with Shailendra with most of the things that he said. I think the debate this time in the MPC will be more around space for cut versus need for cut, right? I think, with the inflation being pretty much in control, last reading was, I think, around 1.5%. We're expecting the October number to be below 1%, closer to like 0.5, right? I think for this full year, I think CPI will average around 2.3% or so. So is there a space for a cut? We think so, right? There is definitely space for cut. But is there a real need currently? I think the rural economy has been quite resilient in India. After the GST cuts, we have seen that the consumption, even in the urban areas, have got a boost, right? I think between monetary as well as fiscal policies, I think there are quite a lot of stimulus that has already been provided this year, right? With the tax cut, GST, income tax, liquidity infusion, as well as 100 basis point of rate cuts. And some of that is still feeding through the system, right? 2 more CRR cuts are actually supposed to come going forward, right? Which will infuse another 1,20,000 crore of liquidity. So again, I think it's going to be a bit tricky in December, given the space for cut. Do they go ahead and do another 25 basis point cut, or they prefer to wait and watch and see how all the stimulus plays out and focus more on transmission of the cuts which have already been done versus another 25 BEPS cut?
Mr. Akshay?
My guess is that they will go through December. Because there has been I will not call it a guidance, but the kind of a language which was spoken by. Also, the fact is that if US start cutting rates a little aggressively, they get a space, which is, I agree with Aditya that the space would be there, whether the need is there or not will come out. But if you see the kind of inflation numbers everybody is talking about, it will become a little difficult not to go for the cut with that kind of number if it's a number-driven scenario. Also, the fact is that while we have seen the euphoria of growth coming just around the busy season with the Diwali and all, the question is, was it a pent-up post the GST reduction announcement versus the actual date of action? And one needs to see if this follow through continues, because so far October has been very good. But if somewhere, and the meeting is in December, so they get another month to read the data and read the leading indicators. So if that starts a little bit of slowing down, then they get a comfort to cut the rate.
Right. Now, this question is again to the three of you on FPI flows in India's debt. I mean, when the bond inclusion thing happened, we saw there was euphoria in the beginning, but then it started to wane out. But in the last 4 months, we have seen FPIs again buying Indian bonds. So where do you see that trend going, especially with the US cutting now?
So, I mean, a lot of it has to do with India's fundamentals. I mean, so, India got a lot of passive flows with the inclusion of JP Morgan in the JP Morgan index. And, but even today, the FPI, investments stand at about 3.2% of the outstanding IGBs. So it's not, it's not that significant. I mean, if the Bloomberg inclusion, we'll get to know by January if that happens. Maybe some more passive flows will happen. But I think, there is a type of FPI flow which is, more stable, which is the passive flow, which came with the JP Morgan. But, interestingly, if you look at the FPI behavior, when the 10-year GSEC yield in April, May fell to 620, I mean, there was a large selling. I mean, almost probably 3-4 billion was sold. And that money has come back when yields have gone up. So, FPIs are also being tactical. I mean, at that time, I think a lot of money was going into other emerging markets like Indonesia, etc. And when those yields fell and the Indian yields rose, I think there was a switch which happened. But overall, the trend in FPI flows into emerging market debt has been very strong. This year, we have already got about $260 billion. Of course, bulk of it has gone to China, about almost 160, 170 out of that is in China. But I think the emerging market growth inflows are strong. And, in the morning session, Dr. Poonam Gupta spoke, emerging market fundamentals are good. So, most of the countries have low CADs or current account surpluses, lower fiscal deficits, lower inflation. I mean, EMs today are looking more like DMs, and some of the DMs, like, we know what's happening there. I mean, high deficits, high inflation. So, the world is quite different. And I think, so in that sense, we are positive on flows from FPIs.
Mr. Bagri.
So let me start with fixed income first, and then maybe I'll go to the equity flows on FPI. On fixed income, I think when India got included in the EM bond index, I think we were expecting a passive flow of about 24 to $25 billion, which if you look at it, it has actually come through. So the number that has come in is around that range, right? And these are mostly more passive investors, right? Then there is an active flow that comes in who normally will come in more fast money if they think their expectation of further rate cuts or bond yields to fall down further, or appreciation in INR. And then these guys will come in, and like Shailendra was mentioning, they had invested, then they got out when yields were closer to 620, and there was a sense that maybe we are at the end of a rate cutting cycle. And then you're seeing some of it come back again right now at around 650, 55, and INR seems fairly valued. So having said that, and again, I think there is a talk, there's been some media reports of India IGBs getting included in another large global fixed income index. If that happens, maybe you'll see another $20 billion of flow come in at the back of that. But after even taking all of that into account, the fact is, I mean, foreigners holding of IGBs in India is like close to 5% or so, right? If you take into account SDL and corporate bond, they're even less. So I think the bond markets in India is majorly driven by domestic institutional investors, right? Mutual funds, pensions, insurance, and banks, of course. And I think there also we have seen demand come off recently because of certain regulatory as well as tax changes. So I think the question is going to be, how can we get that demand back in? That's one on the fixed income. On the equity side, on FPI, again, I think we have seen almost $15-16 billion of outflows this year. And multiple reasons, of course, corporate profitability, valuation, things that people have been talking about, tariff uncertainty. But also what we have seen is a lot of the equity flows have have been chasing like AI-related themes globally. So, certain markets which are predominant in that, like say, Taiwan, Korea, even China to a certain extent, among the EM has benefited from some of that flows going there, right? We are all hoping, foreign investors are underweight now India, from a index weighting perspective. So, if some of the tariff-related issues, growth coming back, and valuation corrects, maybe we will see the FPI coming back in, at least on the equity side.
Structure.
On the debt side, I think, on the equity side, I think Aditya has covered and Sandeep has covered, and I started initially only, so I don't want to harp on that part. But on the debt side, I think, see, the passive flows have come, and they are, I think, $24-25 billion that Aditya mentioned is what the number is, and that is likely to remain. The active flows of another $15 billion had come in, has gone out also. The movement was also quite volatile. From a 620 back to a 650, 55 levels on the 10-year was not something which was anticipated when the market was coming down in the April-May scenario. And then the rate cut happened, and then it became history. That I don't know how it will play out, in the sense that I think it will be also rate driven and the market's expectation driven. Today, do I expect the 10-year coming back to 620? I don't expect that. And that's the moot point for an active FPI investor to come in. Even if there is a rate cut, it will be more of a steepening of the curve rather than actually the entire curve shifting down. Because the short term is going to come off surely, but long term, there are other factors which are playing out, and as Aditya did mention just now about the demand part of it, so that has to be looked at. So passive will continue, but I don't think the overseas money will drive the Indian yields. That will
Domestic
be
investors will.
It will be a domestically driven play here.
I think I have very few minutes left, but I have a few questions, so I'll quickly go run through it. I think I'll ask a question to Jingan sir and Rakshit sir on the corporate bond market. We have seen in Q1 there was huge issuances. Q2 was pretty muted because of high yields. Q3 it's picking up. So how do you see the whole year panning out in terms of corporate bonds? Because banks have been absent, noticeably absent. So how do you see that?
So yeah, I think that's the main point. I think you have hit it on the nail. I mean, last year we saw that the bank issuance was really very strong. I mean, especially tier 2 capital issuance and infra bonds also. This year started well, but it was more tactical on the part of corporates, NBFCs, and mostly PSU issuers. So the main issuers were PSUs and NBFCs. In first quarter, we saw a number of 3.6 trillion. It came down to 2 trillion. Again, like I said, it was tactical in the first quarter. When the yields went up, some of the issuance did slow down. October has also been very tepid. Hardly 60,000 odd has happened. So we think that overall the number last year, which was 11.1 trillion or thereabouts, I think we are going to end at a low number. The main reason I see is that in the loan market, the rates are significantly cheaper. So I think there is a move where corporates are moving away from bonds and accessing the loan market. I mean, with repo rate at 5.5, the EBLR loans look far more attractive compared to corporate bonds at the current level. So I think that trend is pretty much evident. So we think that the supply will be tepid going ahead also.
I agree with Sandeep. I think the fact is that the loan market is much cheaper currently, and with the credit offtake not really in the space that it should be it is easier for a bank also to take it as a loan. Accounting principles have also changed in the way you treat how you hold the corporate bond. So it is something which is tipping out, and with the change in the large framework, that will also, I mean, that was one of the reasons some corporates were looking at bonds that also may not have that necessary demand anymore. So that is a challenge which is coming through. So I see it a lot more tepid.
Mr. Bagri, I had a question on rupee for you. I mean, we've seen rupee being very volatile. It was one of the worst performing currencies. Then suddenly there's a pullback because of RBI intervention. So essentially, where do you see rupee and how do you see RBI's intervention strategy in this?
So you're right. I mean, I think rupee has been an underperformer over the last few months, and I think there are multiple reasons for that. I think one is, of course, generally you will have seen that around July to September quarters, from a seasonality perspective, is the worst quarter for rupee, because you tend to see a lot of outflows related to education, related to defense, dividend outflows around this quarter. A lot of import gets increased pre-festival season. So historically, if you also see, I mean, this quarter you normally see a bit of an underperformance on the rupee side. Second, like we have all been discussing, I think we have not seen portfolio inflows coming into India for, again, I don't want to repeat the reasons, for multiple reasons. We are hopeful going forward with some of these issues getting resolved, right? Growth kind of coming back, corporate profitability, at least all the results that we have seen recently has been better than expected. The fact that foreigners have been underweight India for some time, and hopefully this, the trade deal gets done and the tariff issues gets resolved. Hopefully we'll see portfolio flows coming back, and that should be helpful. And second, of course, I think we are getting in from a seasonality perspective, we are going to get into a good period for rupee. So at least in the next, in the short term, I'm actually a bit more constructive on rupee.
Right. So we'll open the floor to questions. I'll go to Anjali. It's on, sir.
Am I audible?
You are.
See, in USA, 10-year yield is a few basis points above their minimum policy rate. Means government is borrowing almost at the policy rate. In India, government of India is borrowing at least 100 basis points above this policy rate. And it was at some point of time 6.25%. It has gone up to 6.5%, more than 6.5. Don't you think the government is borrowing at a very high rate?
So, basically it's a function of expectation of rates. I mean, the 10-year bond moves in line with, what happens is that when a rate cutting cycle is about to start, or, it's starting, that time the 10-year bond is almost close to where the policy rates are. And then eventually, so markets are forward looking. So that's what's happening. In Fed's case, I mean, you're right that today the policy rate is also 4% and 10-year yield is also at 4%. But then, as Aditya and we all have been saying, that there's a 100 basis type of rate cut which is going to happen. And market has already priced in, and that's why it's trading at the same level. In India, I think there are, demand side challenges also which are there. I mean, the spread is a little wide. I mean, let's say there's one more cut at 5-quarter policy rate, I mean, 10-year at 6.5. I think two things have happened. One is that RBI stance has changed to neutral. So market is saying that, there is no scope for deeper cuts here. So rates are going to go up only. So I think that's why the term spreads are wide. And second, there are demand side challenges which are there. I mean, I can say that in the case of banks, the HTM has become a true HTM book. So there is a tendency to buy only short end over there. And that is bulk of the bank investments. The flows into insurance companies, investors like NPS, etc., going towards G-Secs have slowed down because they're moving towards equity. I mean, like for NPS, the equity allocation has gone up from 15 to 25%. Insurance, the flows are all coming in products like ULIP, which are more equity oriented. Mutual funds, we know that all the flows are either going into equity or into, commodity-based ETFs and things like that. So I think there are various factors. But I would think that, I mean, the yield is at the correct level, I mean, where it should be.
Anjali?
Given the global scenario and the amount, the gold reserves are going up, they are surging actually. So do you think there has been a change in the RBI's reserve strategy where they are investing in gold, and on the other hand, they are intervening by dollar sales.
Anyone like to take that?
RBI gold reserves have gone up purely because of valuation. It's not, I don't think RBI has added much in the near term, but the number you have seen, so almost I think 30 billion is the effect of valuation. So it's not like, RBI has bought anything incrementally in the near term, at least that's what my understanding of it, but this is more a valuation effect. In fact, I mean, today the valuation effect has been so big at the global level that gold holdings of central banks have become bigger even than the UST holdings. So, you want to add?
I think RBI's holding is currently at 880 tons, if I remember correctly the number. So it's not significantly gone up, but yes, I think all central banks have been buying gold. So there was a talk, or there is still that discussion that will dollar hold its strength? The dollar can have a weakness coming in. If you look at some of the advisors to the Trump government, they had been propagating this theory for about a year that dollar can become a lot more weaker. So obviously gold acts as a hedge. So I think buying gold has nothing to do with the RBI's rupee management strategy. And it is more, rupee management strategy is more to moderate the volatility of the rupee. I mean, and that has been the open strategy of RBI, that we don't want a one-way movement, we want a volatility to be curtailed.
Okay, one more question I have. So the spread between SDL and GSEC, it has widened a lot in last 2 quarters. So has it changed your investment portfolio strategy? Have you allocated more to SDLs given the higher return?
It has in fact come down now. It had gone up to a 75, 80, even almost 100 basis. It's now back to almost a 40, 45 basis, 50 basis. So it's a dynamic scenario, and it's also a question of an evaluation of individual states and how one looks at different credit risks and things. Does it change investment strategy? I don't think that happens. I mean, these are only a part of the overall portfolio of looking at how you shore up your reserves. I mean, rather the SLR book. Sorry.
So do you want to add anything? Any more questions?
Yeah, hi sir. This is Kabir from Infomist. I have one question regarding what Mr. Sethi said in the morning, that bank loans are not picking up because corporates are going to capital markets to raise money. But here we are saying that there are less issuances because corporates are going to banks to get loans.
We were talking about corporate bond issuances, not the question was between corporate bonds and loans. So we were saying that corporates are preferring loans over corporate bonds. I mean, equity is a different question altogether. Obviously,
right.
Equity is the cheapest.
Right.
It's the best asset to raise money from today.
Okay.
I think both the statements are right in that sense that in the Q1, if you see, the bank loans were not picking up.
Right.
What Sandeep mentioned was something which is happening of late. The loans have become cheaper than the bonds, and that's why Q1 you saw corporate bond issuance a lot more. So, and Q1 was not when the liquidity got released. Liquidity
Right.
started getting released towards the end of Q1. And that's where the banks did get enough liquidity to then look at a different approach on the loan book. And that's where the loans have now started picking up.
Okay, sir. And sir, another question on exchange rate. So Dr. Gupta just said that it cannot be a monetary policy tool to promote export competitiveness. Exchange rates cannot be used as a monetary policy tool. So given the tariff conditions right now and assuming that the tariffs will be imposed, how do you think RBI can change their intervention strategy as to still keep exports lucrative?
I'll take this. I don't think it is the RBI will determine whether export is lucrative or not. Ultimately, productivity will determine whether exports are lucrative or not. So the RBI's stated objective on currency is that they will moderate the volatility.
Yes.
So if it is not about anything other than moderation of volatility. Now, it is not something like you will see a 1991 where there was a forced depreciation twice and then we moved to for an export competitiveness. I think export competitiveness will come in from how India negotiates on other FTAs, other jurisdictions, other geographies. And if you see the data last month's data or last quarter's data, India's exports to other geographies have picked up. So it will be a more from that perspective. I don't see a currency being used to give a rupee, to give a benefit to the exporters. If at all, if something has to come through, it has to come through some other route. Like earlier, there used to be those special rates, special interest rate subventions being given by Government of India from that perspective. But I don't see currency being used as that.
Right, so thanks.
Mr. Bagri, would you like to add?
No, I agree, Arup, with what you said. And I was just going to add to that. I think Dr. Gupta was correct, right? MPC has a very clear mandate. It's about controlling inflation, inflation within a particular range of 4% with 2% plus and minus, and growth, right? I don't think we can use monetary policy for giving boost to growth, or FX for as a monetary policy tool.
So that's the time we had. Thank you all for joining us for this panel discussion. I think we had a fruitful discussion. Thank you, everyone.